Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to businessman, investor, commentator, and journalist Liam Halligan of The Telegraph. Liam, welcome to the Keiser Report.
Max, good to be here. Good to see you.
You know, I haven't seen you since...
Even though our ties clash.
Well, I haven't seen you since Kilkenny, where we ripped up the Kilconomics Economics Forum. Do you remember? It was fantastic.
There we were in the southeast of Ireland, the sunny southeast, as the locals call it. What an amazing combination under David McWilliams' directorship. Get together some economists from all over the world and have them chaired by sharp, stand-up Irish comedians. Surely it's only a matter of time before Kilconomics comes to London.
Well, it's fantastic because they popularize economics in a way that the average punter can understand it. So we have you here today to help us get through some of these comments by the Chancellor, George Osborne, who gave his autumn statement last week, and he says it's boom times. But foreign trade and fixed investments are declining. Household debt-fueled consumption is rising. The worst drop in living standards in the UK since the Victorian era. Liam, what's going on?
Well, the first thing to notice about the autumn statement, Max, is that it was late. It wasn't only a winter statement rather than an autumn statement. It was also edged forward in the diary because George Osborne and David Cameron, of course, wanted to go to China in order to raise some new inward investment for the UK. So that just shows you where the balance of power is. But this was always going to be a political triumph for Osborne. He's had the biggest upgrade in growth forecast between fiscal statements for 14 years in this country. What really worries me is that even though, yes, the deficit is falling, the debt in this country is massively spiraling and we must service all that debt. Also, it's the wrong kind of growth. You know, the estimates for consumption were more than doubled between the budget in March and the autumn statement that we've just heard, while the estimates for fixed investment were slashed. Fixed investment in this country is now going to fall by almost 2.5% according to the Office for Budget Responsibility. So this is kind of a cappuccino recovery. There's lots of froth on top. It kind of gives you a quick hit. But where's the beef?
This kind of stood out here. The worst drop in living standards since the Victorian era here in the UK. Now, we've been saying on this show for a while, and I've been reading your columns in the Telegraph, and I know you have been looking into this as well, that you've got this interesting economy here in the UK where it's money printing or debt creation is servicing the very top. But the vast majority of folks here in the UK are experiencing the sharpest drop in living standards since Victorian era. Talk about that a little bit.
Well, of course, here in the UK, the Bank of England has almost quadrupled its balance sheet since 2009. The Federal Reserve's increased its balance sheet under QE almost threefold. Both the big Anglo-Saxon economies are, of course, out-Japanesing the Japanese now. And it seems incredible to me that, yes, we do have this increase in nominal GDP, and we're looking at 1.5% growth for 2013, according to the Office of Budget Responsibility. But, Max, you know, the increase in government borrowing is bigger than the increase in nominal GDP. So, in some senses, the whole GDP increase is just government borrowing. And of course, a lot of those gilts, almost a third of all outstanding gilts now, but more, of course, at the margin, are bought by the Bank of England using virtually printed money. So in some ways, you know, I'm really glad that the UK growth outlook's looking up. I'm delighted, of course, that unemployment isn't nearly as bad as the recessions of the early 80s and the early 90s that I grew up with. But you've got to worry about the sustainability of this recovery now, given that we are floating in the UK on a wave of printed money. How would our gilts market look if we weren't doing QE, if we hadn't done QE to the extent that we are? And what happens, Max, you know, personal indebted just peaked in this country. It's now at a record high. A lot of this extra consumption is coming out of this saving and also extra credit, particularly in the run-up to Christmas. What happens when interest rates start crawling upward from their current historic low? And this isn't about the Bank of England moving too early. In the end, if the market wants to impose higher interest rates, the market will impose higher interest rates. There's nothing that any central banker can do about that, whether he's good at ice hockey and looks like a rock star. It doesn't matter. In the end, the market will impose higher interest rates. My concern, and I'm trying not to be a Cassandra, I'm just pointing out the realities that a lot of the mainstream commentators seem to be ignoring. My concern is what happens if households stress test their personal finances at 3, 4, 5% base rates of interest, which then, of course, will kick up in the commercial marketplace where people actually borrow and lend.
So when they talk about living standards falling sharply, you just look at a couple of numbers. As you point out, debt is growing faster than GDP. Another interesting number is that wages are way below even the government's stated inflation rate, which is considerably less than the actual inflation rate if you include things like food and energy. So between those two, having declining wages and
housing,
and you put it all together, and your living standards start to collapse. And so the policy, therefore, from Osborne and crew, you have to ask yourself, are they tone deaf? They don't understand the damage that they're doing, or are they just servicing a few folks to get reelected? I think the answer is self-evident. I want to kind of move on here. The Russian economy, let's talk about that for a moment. The ministry revised down their economic forecasts for 2013 to 2015. Now, you've lived in Russia, and you're a bit of an expert on the Russian economy.
To the extent that anyone is.
Yeah, I mean, it has been opaque up until recently. You've lived there, you've done business there. So let's get your insight a little bit on what's going on in the Russian economy, because we don't talk about it enough on this show.
Sure. Okay, this is the largest retail market in Europe now. This will be the biggest economy in Europe by the time my kids hit the jobs market, and my oldest daughter is 13. This is structurally a very sound economy. If you look at the government balance sheet and household balance sheets, Russia has total sovereign debt of 10% of GDP. So its total debt is pretty much in the ballpark of our annual deficit. We're adding as much each year as they actually have. In net terms, of course, Russia is a net creditor to the world, having defaulted, of course, back in the late 90s. A tremendous turnaround. Basic rate of income tax is 13%. There is a lot of very interesting business going on in Russia, and there's a hell of a lot of foreign direct investment, not least from US firms and also from German firms, though the Brits have been a lot more reticent, I must say. In recent months, of course, Russia has slowed down slightly. It's now looking at 1 to 2% GDP growth this year, as opposed to the sort of 4 or 5% that it's averaged over the last 10 to 15 years. Russia does have an image problem. That's partly externally imposed, because a lot of Western people have lots of Cold War hang-ups.
I want to jump in here for a second.
It's partly also Russia shooting itself in the foot and not really being diligent enough about trying to polish its reputation and look more open to foreign investors. You know, if you want to start a bank in Russia, it's a lot easier than starting a bank in China or India if you're a foreigner. Two of the top 5 banks in Russia are foreign. Lots of the largest retail chains are foreign, tend to be French and German again, rather than British. It's a lot more open than it looks. It's got an open capital account. I've certainly had really good experiences living there over the years, but it does have to work harder to sell itself.
Well, my perception of the Russian economy is that when oil prices are high, everyone's really happy, and they're not incentivized to change or diversify into other areas, economically speaking, because they are very reliant on gas and oil. And then when prices are low, then their feeling is, well, we can't change now because we have to deal with these low prices. So as a result, they stay locked in this petro-driven economy, and they're unwilling to diversify or haven't diversified, although we have now seen a diversification into more of a technology space, and they are doing some great things in the tech space. But talk about the image problem you just mentioned. Here we are told from, let's say, the Guardian newspaper about folks like Kordoskovsky, and who's held up as a fellow who's being subjected to all manner of persecution by the Russian government. There is a competing view to this. Can you speak on that?
Sure. Just on the oil point, the Russian stock market isn't the economy. Yes, the stock market, or the index, the main index is dominated by oil and gas stock. The actual stock market isn't. There's a lot of mid and lower tier firms that aren't oil and gas. But oil and gas now is only 16% of the economy. It was 40% back in 2003.
Okay,
that's
really?
about the same as Norway, yeah? The Russian model is to have, yes, lots of minerals and resources, and currently, we're going from 7 to 9 billion people in the world. I'd rather have the minerals and resources than not have them.
On the retail side, we see remarkable growth as well. Retail.
Absolutely.
Talk about the retail side.
Sure. Well, you have the largest retail market in Europe, as I said, or almost the largest retail market in Europe by dollar value. It will probably overtake Germany this year. It's already the biggest market in Europe by dollar value for cars, white goods, juice, beverages of all kinds. That's why you have got under the radar so much FDI, so much inward investment. You know, the model is kind of an Australian or a Nordic model. You have the resources, but you have lots and lots of smarts as well, and you move up the value chain. That's clearly what we've been seeing. But of course, most foreign investors who read their FT and The Economist, all they focus on are the equities. And a lot of the equities are focused on oil and gas, but beyond that, there's lots of other investment opportunities. What I'd say about Khodorkovsky is this. The vast majority of Russians are pretty happy that there's been a clampdown on the oligarchs. You know, in the late 90s, Khodorkovsky and some other oligarchs, they basically tried to buy the Duma and prevent punitive tax regimes on oil and gas going through the Duma. In the end, those punitive tax regimes on oil and gas, both foreign companies and domestic companies, did go through. You do have very high taxation on oil exports in Russia. That money has been used largely, of course, some of it's disappeared. This is the real world. This is a nascent capitalist society. But the bulk of that money has been used to build up the third biggest foreign exchange reserves in the world, pay off all the debt in net terms, and build a war chest of macroeconomic stability. Of course, Russia isn't immune to image problems from overseas, but the reality is that Putin was the West's favourite guy in the early 2000s. It was only when he started to impose heavy oil and gas taxation that the Western oil majors got really upset, and he went from being a guy who, you know, George Bush could look into his soul to being public enemy number one.
Let's talk about the deal with Iran. How much does this have to do with peak oil? WikiLeaks diplomatic cables show that the U.S. believes that Saudi oil reserves may be 40% overstated. Is Saudi Arabia just not that important anymore? We've only got about 20 seconds left.
It does strike me as crazy that Saudi could be pumping 22 million barrels a day from the current 9 or 10 by 2025, yet that's what all the Energy Information Agency and IEA estimates show. Clearly that's not going to happen, so they are overstated.
Liam Halligan, we're out of time. We got to go. Thanks for being on the Keiser Report.
A pleasure and a privilege.
And that's